Welcome to all of our participants. A special welcome to Rana. And let me begin, if I could, with a sort of personal anecdote. Every morning between 5:30 and 6 o'clock, the first thing I do is get the Financial Times. I mean, quite frankly, it's not a joke. John Yost knows me. I've been doing this for getting up early for years. But I turn to the Financial Times, frankly, to find out what's going on in the world. And when I turn to the Financial Times, I look to see, is there an article by Martin Wolf? Is there an article by Gillian Tett? Is there an article by Rana Foroohar? Because quite frankly, I think they are three of the finest journalists writing in the world. I mean, quite candidly. And then I figured out why Rana is so good. She has an undergraduate degree, a BA in English from Barnard. But I've come to look for these three writers, and in particular, Rana's recent work on technology and big data really struck me. It's why I asked her if she would do this. But she is the officially the associate editor at the Financial Times. She's also CNN's global economics analyst, and I also want to commend to those of you on the call her last book. It's called Makers and Takers. The subtitle, and I'll ask her about this a little bit later, is How Wall Street Destroyed Main Street. I'd like to, Rana, particularly ask you whether that's still underway and whether you have an update to Makers and Takers. But again, we are really honored that you could join us, and thank you very much for making the time today, and the floor is yours.
Okay, well, thank you so much for that introduction. Really happy to be here and happy to have a chance to talk about this book. It does seem to be another moment for Makers and Takers. This book, I'll start by kind of telling you the genesis of it. I actually had been working, prior to the financial crisis, I'd been working in Europe as a European economic correspondent for Newsweek and then for Time. And I moved back to the U.S. in 2007 to take over economics and business for Newsweek and then later for Time. And so in that sense, I wasn't a beat reporter looking at the financial sector, but I was sort of pulling back and really taking a worldview as to what was going on and looking at the crisis as it unfolded, but really as somebody that had kind of a macro view. And so this is important because I think that one of the things I tried to do in this book was kind of create a new narrative as to what happened during the crisis, after the crisis, over the last 10 years, why we still have such a disconnect between Wall Street and Main Street. And you can see that very clearly over the last few years in the markets, being really, even still after the turmoil the last couple of weeks, near record highs, even though you have an economy that is still, by historical standards, having subpar growth. So I came back to the US in 2007, immediately stepped into the financial crisis covering that. And I always felt that there was not really a proper narrative that had been developed. We had a narrative about certain banks and their misdeeds, certain CEOs and their misdeeds, but we didn't really have a narrative about what happened that we have a financial system that could create this sort of nuclear bomb and go off and still really not be properly regulated, I believe, several years on. So I kind of had my light bulb moment, I guess I would say, in it was 2012 or 2013. I can't remember quite the year, but it's in the introduction of my book, where I was sitting in an off-the-record meeting with a former Treasury Department official who'd been very intimately involved in some of the bailouts. And we were talking about, I guess, a kind of a post-op of what had happened. And his take was that, hey, things are under control, nothing to see here, everything's cleaned up, we've kind of done a great job with this situation, basically kind of wrapping a bow around the Obama administration's handling of the crisis. And I had been looking at some academic research around lobbying by the financial sector around the Dodd-Frank rules. And what I had found, which by the way, at that point, 2012, 2013, were only about halfway written. And what I had found is that the largest banks, a handful of the largest banks, all the usual names, had taken 96% of all the public consultation meetings around some of the most important and contentious bits of regulation, the Volcker Rule, for example, derivatives, etc. So I raised my hand and I put this stat out there. I said, well, how can you really say that things have been handled properly when 96% of all the meetings have been taken with the largest banks? I mean, it really feels like it's sort of a captured audience. And the official looked at me with real befuddlement and said, well, who else should we have been speaking to? And that was just this kind of wow moment. And it was interesting. I remember looking around the crew of journalists that was in the room, and most of them were financial beat reporters who were very much in the weeds of the story. And I thought for sure everybody would be furiously scribbling, and no one was. And that's when it really dawned on me that not only is the public sector captured by Wall Street, but the financial media is captured by Wall Street, and we really don't understand what happened here. So I began looking more carefully at this issue, and one of the things that really struck me and has always startled me, frankly, over my 25 years or so of business and financial and market reporting is the way in which companies themselves were being victimized by Wall Street. So I think one of the interesting narratives, we kind of got the idea that it was the little guy versus the big banks post-financial crisis, but I didn't find that people were really setting up this interesting dichotomy of we now have a capital market structure that actually doesn't support business. So I would see business leaders being pushed into just taking really, really bad decisions from the street. And this is, of course, bubbled up in the last year or two into this long-term versus short-termism debate that you see Larry Fink and others weighing in on. And I'll kind of come to that more in depth in a moment and break that out. But so I had these two ideas. We don't have the right narrative about risk in our financial sector. We don't have the right narrative about what the financial sector is for. And we clearly no longer have a financial system that's really supporting business, which if you kind of go back to the roots of modern capitalism, go back to Adam Smith, that's what the financial system was set up to do. It was really set up as a catalyst to support other kinds of business. And in fact, Smith believed that three things needed to be in place for the system of market capitalism to work properly. He thought that both parties on either side of a transaction, on either side of a market, needed to have equal access to information, transparency within the transaction, and a shared moral framework. And I would argue that none of those things are really in play now, certainly between individuals in the street, but also between corporations in the street. So as I started digging into this statistically, I found a couple of figures that I found amazing and startling. So one of them was just the sheer sort of monopoly power of the largest financial institutions, which, by the way, is stronger now post-crisis because there's been consolidation in the sector. So you've got fewer institutions holding more power. And the statistic that really struck me was that the financial sector, and in that I'm including basically the formal banking sector, certain aspects of real estate, basically any business that is in the business of moving money around, not the shadow banking sector. This sector creates about 4% of all jobs in the economy, takes up roughly 7% of GDP, but takes a quarter of all corporate profits. So that's a really disproportionate amount of profit share taking versus jobs created. So that's point number one. And when you have an industry that has, I would argue, that has that much economic power and yet is really not creating that many jobs, you've got a sort of a disconnect in terms of value added. There's also a lot of data, by the way, to show that as the financial sector has gotten bigger, fees have gotten higher. There's actually been more rent seeking. And again, I think that this is part and parcel of the monopoly power of the industry. So there's that. The other stat that really struck me was some research that was done by a couple of European academics, and this is all footnoted in my book. Alan Taylor, who's now out in California at Berkeley, and Maurice Schulerek, who's a European academic, did some work looking at financial flows, and they found that only about 15% of all of the money coming out of the largest financial institutions was going to Main Street, so to kind of new business investment. And so what was the other 85% doing? Well, it was basically being used for trading. It was sort of existing in this closed loop of the financial sector itself. And so that tells me two things. A, that tells me that the capital markets are no longer doing what they were set up to do. Now you can argue whether they're doing something different, something necessary, but you have to say the system that we think we have is not really what we have today, because most of the money it's not going into Main Street businesses. That's very different from, say, the 1970s, when the majority of that money would have been going into Main Street business. So that's a big shift in the last 40 years. The other thing you can say is, all right, so what does that new ecosystem, this huge pot of money that's existing for the purposes of trading and the buying and selling of existing assets, what does that do to the economy? Well, there's a lot of research, and again, all footnoted in my book, to show that it increases volatility. You can look at that through the lens of the number of financial crises, the number of market events that has happened as the financial sector has grown, not just in the US, but in most OECD countries. It's increased wealth inequality, because if you look at who holds financial assets, if I'm being very generous, I would say it's the top 20% that holds, say, 80% of the assets. But of course, you could look at the top 1% holding the bulk of that 80% as well. So you've got more volatility, you've got wealth inequality, which in and of itself has a growth dampening effect on the economy, because to put it in very simplistic terms, there's only so many houses and cars and pairs of jeans that the rich can buy. So in a 70% consumer economy of the kind that we have, if you don't have more spending power in the middle, and if you have that wealth inequality, then you get slower growth. And I think that that's pretty widely acknowledged now. So here you have a market system that's absolutely not working the way it's supposed to. And you have corporations that are interacting with that market system in ways that are completely Kafkaesque. And so I'll just share with you an example that I think is really quite timely from the intro chapter of the book. I tried to look out over the corporate financial landscape and find the most bizarre example of how we have this system that's now sort of turned on its head, where the financial markets have become the tail that wags the dog. And the example that I came up with was around Apple Computer, which is most profitable company, richest company, most cash on hand, like in the history of the world, basically. So if you look at what this company, which you could argue in the past has been one of the country's major innovators, what it's been doing with that money over the last few years, you see that there's been a huge amount of cash offshoring, not illegal, but due to tax loopholes, a lot of ability to put cash in overseas tax havens. And at the same time, post-financial crisis, because of the steps that the Fed took and the very low interest rate environment that I think, needed certainly for a time to get the economy back on its feet, because of those low rates, corporations like Apple that had very high credit ratings were able to play a kind of a credit arbitrage, where they would use their own credit rating and the very low rate environment to issue huge amounts of debt on the US markets, use that debt mainly to pay back shareholders in the form of dividends and share buybacks. So you have people like, say, Carl Icahn, who has dumped the stock since, but at the time they started these buybacks, he owned about 5% of the company. You have people like that getting enormous payouts, people that didn't, and entities that didn't have anything to do with the founding of this company. Meanwhile, you have tax offshoring in equal amounts. So what was amazing is that Apple at the time had about 250 billion, I think it's closer to 300 billion now, in offshore cash, but it was issuing roughly the same amount of debt in the US markets to pay back investors. And so there's this bizarre situation now where companies that don't need capital are the most involved in the capital markets. At the same time, you have, of course, as everybody knows, a huge amount of credit contraction, not just for individuals, but for small businesses post-financial crisis. So the people that really needed capital couldn't get it. The companies that needed no capital had it in spades. And at the same time, you've got this financial maneuvering, this tax optimization, whatever you want to call it, happening at a global level, which I would argue was having an incredibly destructive effect on not just state budgets, but politics because of that. Because you didn't, you had more debt burden on the state, lower tax intake, inability to put, I would argue, proper safety nets under people during the crisis, and slower growth as a result. So that's sort of the main thesis of the book, and I'm going to stop talking and just a minute, but I'll kind of just quickly lay out what I did then was from that stepping off point, go industry by industry and try and find examples of the ways in which this shift in both the size and the business model of Wall Street had really had a destructive effect on the economy. And I'm happy to talk about any of those in more detail, but I looked, for example, at the real estate sector. And post-crisis, you had a situation now where private equity had become the largest owner of single-family homes in America because they were able to come in, buy stuff up on the courthouse steps at auction. Individuals weren't able to get mortgages. So that's, one dysfunctional aspect I look at in the book. I look at the way in which derivatives trading, for example, one of the key sort of blow up points in the last financial crisis was not properly regulated, in part because of the political lobbying power of these firms and how that played out. I looked at the tax structure and the ways in which we have a tax code that in many ways subsidizes debt, unproductive kinds of debt, I should say, dangerous kinds of debt, rewards behavior that enriches Wall Street but actually doesn't help underlying growth, and so on and so forth. So at the end of the book, I have some ideas for solutions. Some of them are sort of technical, others are kind of existential, and I guess I would maybe end with one of the more existential points, but I think it's an important one, which is that we have had a debate, I think, and continue to have one over the last 10 years that is very, very technocratic, very complex, tends to favor vested interests and insiders in terms of here's how we should be fixing this or that particular rule within the financial system. We should make institutions hold X amount of tier 1 capital or have this or that leverage ratio. Yes, these are important questions. Yes, we need to discuss them, but there's a bigger narrative here, which is that we need a financial system, we need a capital market system that supports the real economy. Otherwise, the rest of it kind of doesn't matter, I would argue. So that's where the book is. I think that we're at an interesting point. The piece that Charles mentioned that I did this past Monday for the FT kind of takes that Apple story, which is now grown and been quantified by other institutions, and broadens it out and looks at the ways in which some of the big tech firms are acting themselves as financial institutions now and have become financial engineers rather than the real kind, I would argue. And so maybe I'll stop there and use that as a stepping off point to start the question and answer period.
Rana, thank you very much. I mean, this is really fascinating. I know I could go like the rest of the day with questions. Let me just start with a couple. Some years ago, I worked at the Office of Management and Budget under David Stockman. I don't recall you citing Dave in your book. You may have. But,
I have a couple of things.
I'm sorry?
I have a couple of things in there from OMB.
Okay, well, Dave Stockman, I think, has been making for the last couple of years a very similar point, that you've got this financial sector which could be playing its traditional role and thereby doing a lot of good, but he argues that a lot of this money has just, a lot of the stimulus money, the money that has come in through the Fed, through quantitative easing, and then through 104 months of almost zero interest rate policy, has, one, distorted the system, prevented real price discovery, and has created basically financial windfalls for the people at the top who know how to arbitrage the system. So his analysis is very, very interesting. It's very similar to yours. I think he must have read your book to
I don't know. I think maybe he had the idea before me and he just didn't write the book.
So how do you put this genie back in the bottle? And I mean, do you think that he's right on the impact of the distortion here and the arbitrage that goes on? How do you flip this tail wagging the dog situation that we have?
So yeah, I totally agree with that analysis, and it's such an interesting and multi-layered question. So let me kind of take that in 2 or 3 parts here. First of all, he's making, hopefully this book is making kind of a really big picture point here, which is that we have a political economy that has taken decisions that are actually kind of forwarding this problematic process of financialization. Now, you go back to the crisis, I don't think the Fed had any choice but to act, right? I mean, they were kind of the last men and women standing in Washington. And so there had to be a policy of quantitative easing, I would argue. I think that the first round of that was necessary. The second round may have been necessary. But as we went for the third round and have continued really, even now into a historically really, really low rate environment, although it looks like, of course, that's probably going to change soon, or may change soon. This is unprecedented. I mean, we are really in unknown territory. If you look at the amount of money the Fed has dumped into the market, $4 trillion in the last 10 years. Globally, central banks have dumped $30 trillion in. So you could ask anybody on the street, is that having a distorting effect? Of course it is. I mean, one of my sources in the book actually is Morgan Stanley's head of emerging markets, and one of their chief economists at the investment division, Ruchir Sharma. And he said, what do you think happens when you give bankers a lot of easy money to play with? They brew up new kinds of bubbles. And you can look, and I started to look in the book, and you can see a bigger trail now, 2-3 years on. Where has all that debt gone? Well, a lot of it went into the emerging markets, a lot of it went into commodities. And you already began to see the effect of that 2-3 years ago when the Fed announced that it was going to start pulling back from quantitative easing. You saw the taper tantrum, if you remember. So the markets became very volatile for a while then. In the last couple of weeks, you're seeing, with this idea that, inflation might be back. It's ironic, wage growth on Main Street makes Wall Street suddenly panic. And so you get, again, this disconnect. Wage growth, which we ultimately need for the right reasons, not saccharine artificial inflation, but real kind of inflation and wage growth as a product of productivity. We need that. Yet when it starts to go up, inflation expectations go up, interest rate expectations go up, and then you get worries that, hey, this tide of easy money is going to be pulled back in, and then you're going to see who's been swimming without their shorts. And so I think that you're actually seeing that now. That's Warren Buffett's line, by the way. I didn't make that up. But so to go to your point about what we can do, well, I think that the new Fed chair is going to be in a very tough and very interesting position, because I think, Janet Yellen has did a great job of steering the ship over the last few years. But now we're at this point where, what is this balance going to be? We have to pull back from a low interest rate environment ultimately, but do we really have an economy underneath the asset price inflation that is stable? And I think that there's a really big question about that now. A lot of the smartest people that I know on the street are quite worried, actually, that the wealth effect itself of markets being so high and so inflated by all that easy money has been responsible for a disproportionate part of economic growth. So the fact that people feel wealthier has made them, spend more. You see debt levels rising. You see defaults starting to happen in areas like auto, student loans, certain kinds of risky lending. So I think that we are at a very fragile point. Ultimately, though, we're going to have to wean ourselves off of easy money. And I think that that's going to happen regardless of what politicians would like, because the Fed is kind of out of ammo now. And I do think that we're really at a sea change there, not just for the last 10 years, but arguably for the last 40. Because, in my book, and I'm sorry if I'm going on too long, but just to make this broader kind of political economy point, in my book, I talk about how we were at a similar point in some ways in the 1970s where, okay, mature economy, we'd had 2 decades of very high post-war growth, and then the environment changed. You had the emerging markets coming online, you had Europe back on its feet really properly after the post-World War II period, and the US economy was more mature. And so we were at a big political decision-making point about how were we going to grow. We're a more mature economy, but what will our growth strategy be? Will we take a strategy like, say, the Germans did and say, okay, we're a wealthy country. We're not going to be able to compete on price here, but we can compete on skill and productivity. We're going to make a decision to have a high wage economy, and then we're going to make fiscal and monetary decisions based on that. We didn't do that. We passed the buck to the markets. I would argue that politicians, frankly, on both sides of the aisle, passed the buck to the Fed. The Fed started what has been 4 decades of low interest rate policy, easy money policy, and we are now, I think, at a major change point around that. And I think that you'll see that in the markets, certainly in the next few weeks and probably months as we start to shake out and see, okay, where is that risk?
Let me ask one more question, and I'll turn it over to my colleagues or other participants. But Makers and Takers really looks at what I guess you could call big finance. And so recently you've been also writing about big tech. And an article that I think was really very, very important was about a month ago, third week of January. You had a piece in the FT called Big Tech Should Hit the Restart Button. And you argued that some of the tech platforms were actually having adverse effects on liberal democracy. Of course, Disrupt DC is all about strengthening our institutions, but we also have this West Coast presence as well. So could you elaborate a bit more on what you see as the challenges and the opportunities for big tech as we go along? Or maybe that's your next book. I don't know.
I hope it will be my next book. I'm actually working up my proposal, so in between columns. So yeah, I started focusing on tech actually, as part of Makers and Takers, because as I saw how financialized companies like, say, Apple had become, it made me really think, okay, this is interesting. These companies are holding so much cash now, so much power, economically, politically. And so when I joined the FT, I started really digging into that, and I found a very interesting stat. It comes from a McKinsey Global Institute study looking at corporate wealth. It's called Corporate Debt and, in parentheses, Not Much Deleveraging. And it looks at how about 80% of the corporate wealth portion of the pie, which, by the way, is now the biggest portion of the pie. If you divide the whole economy into private sector, corporations, consumers, and the public sector, corporations now hold a disproportionate amount of wealth, and that balance is kind of out of historical alignment. So of that corporate sector, you've got 80% held by the top 10% of very IP-rich companies. So companies, you can kind of think of the top names: Google, Apple, Facebook. Big platform firms that are incredibly cash rich, have very low cost of business, say, relative to companies of similar market size in the past. They create very few jobs compared to companies of the same market size in the past. They pay lower taxes relative to other kinds of corporations because of the nature of the business. And this is a bigger issue, and this is, I think, where you're going, where financialization and technological disruption kind of start to interact in a potentially very toxic way, but also in a way that I think could be shifted, and I'll maybe get to some solutions in a minute. So you've got these companies holding the world's largest pot of money. They are holding it largely in offshore havens. There's now a global race, and you can see this in the fight between US and Europe and Asia around who's going to get that tax money, how they're going to get it. You have a race to the bottom, regulatory arbitrage. What's interesting and ironic, and to me problematic, is that a lot of the kind of basic innovations of these firms was publicly funded. If you look at, say, what makes a smartphone smart, it's things like the internet, which it came out of DARPA, GPS, touchscreen technology. All these things are, were started as basic research in the public sector. So to me, there's something wrong with the taxpayers really at large not being able to capture the benefits of more of that wealth. So you've got that problem. You've then added, when you take the economic issue, you then go to the political, which is over the last 10 years, these firms have become, they vie for the kind of top 1, 2, 3 positions as political lobbying entities in Washington. And that's just the money that we can see. And it tends to go year on year, depending on what issues are up for grabs. But basically, the top tech companies are now the biggest lobbyists, along with the big financial firms and pharma to a certain extent. And so you have political capture of the same kind that you had that I'm talking about in Makers and Takers with the financial sector. You now have a tech sector that has really captured a lot of Washington via direct political donations, but also cognitive capture. And you can see that because a lot of academics, for example, that are producing research that would be read by legislators and regulators, and amicus briefs that are read by the Supreme Court, are funded by the largest tech companies. And that's perfectly legal, but it's not always well disclosed. So I would argue that there's a real cognitive capture here that's problematic. And then I would argue that there's actually a health risk, and that may sound extreme, but you all have probably been following some of my sources. Roger McNamee, for example, who was an early investor in both Google and Facebook, has waged a big campaign in Washington to get people to really wake up to the fact that, hey, these devices, these platforms have captured so much of our attention that they've actually distorted the political process, not only through just what we know in terms of Russian election manipulation on some of the largest platforms, but just the amount of attention that they're now drawing. So if you look at where most Americans now get their news, over 50% of them get them from platform technology sites, Facebook, etc. But you can also look at statistics showing that when you get your news from those sites, you tend to have less trust in institutions, less trust in the democratic process in general. There's correlations. The Edelman Trust Barometer is a good recent piece of research that looks at this, that shows that as you have more people getting their news this way, you have declining trust in institutions, more polarized politics, et cetera. So all those things taken together, and the health risk issue that I mentioned, kids just using these technologies in such a way that it really is addictive. People have said, do we need an FDA for technology? I think all these things together really create a big political crisis. And what's very concerning to me, I have to say, and I've raised this again and again with tech CEOs, I do not think there has been a come to Jesus moment yet in the industry about this. I mean, there have been efforts in kind of siloed ways to take on some of these issues, but I don't think that the industry as a whole and the leadership of some of the largest companies have really stepped back, taken on their toughest critics and said, this is an issue. This is an issue for us as a private sector that thrives in liberal democracy. How are we going to address
I said I asked no more questions, but I can't help myself here. Just one follow-up. You want to talk about Larry Fink's appeal to his fellow CEOs and loop that back into what you just said? Will Larry Fink's at BlackRock, will his appeal help the tech or the financial sector respond to some of these challenges?
So it's a great question. When I was at the World Economic Forum in Davos, I did an event with him there. I talked to a lot of CEOs and a lot of policy folks there, and I asked them this question. The consensus, and I think this is probably right, is that it's a good marker that the investment community now takes these issues very seriously. And this is something I found interestingly when Makers and Takers came out. I expected CEOs to be like, yay, someone's finally in our corner arguing for less pressure from the street. It's actually the financial types that came up to me and said, the more enlightened hedge fund managers and people that were really at the cutting edge of the markets, and said, this is a great point. This is actually now a market risk. And so I think that Larry is, one of the biggest asset managers to come out and say this. What I'm hearing though from companies is that, okay, what's the next step? What is the metric we should be looking at? What is the action plan for dealing with these issues? How are we going to be judged by firms like BlackRock? And so I think that there's now a push and big questions. And I hear people asking Larry and others that, what is this new framework? Not that you want to get obsessively focused on one metric, but if the metric is not, all right, we're going to jack up the share price quarter on quarter, what is the metric? What is this new ecosystem? How do we define it? And so I think we're going to see a lot of conversation about that in the next, 1 to 3 years, I would say.
This is a huge opportunity, though, for corporate America and certainly for the financial sector and for financial services sector and for Silicon Valley.
Oh, I think so. And I think you're starting to see people engage in an interesting way around these issues, trying to figure out what is the best marker for long-term performance. One thing I would say, and this was a fascinating thing that I put in Makers and Takers, I looked at a study comparing the performance of public sector companies versus private sector companies, as much apples to apples as you can get by size and industry. And this study, 25-year study, found that private firms, often family-owned firms, tend to invest about twice as much in productive CapEx. So things like worker training, new factories, technological upgrades to equipment, things like that would be really productive, as opposed to, say, doing the more financial engineering type things, the buybacks, et cetera. So I think that that pressure from the street is just clearly a really important part of what's going on. On the other hand, you don't want to have less transparency. So, do you want to throw out quarterly earnings reports? I don't know that you want to do that. I think you want to start having a much greater variety of performance metrics, though. And you also want to have an understanding on the part of the street and the investment community that the decisions that CEOs are having to take now are really kind of 5 to 10 year decisions. They're about Internet of Things, about AI, about big data, how all these things are going to be integrated into the business models. These are big investments. They're things that aren't going to pay off quarter by quarter. And so I think to the extent that you just keep driving that message home, it's a good thing.
Let me ask Chris, do we have participants who would like to ask Rana a question? Dan, welcome.
Thank you, Charles, and thank you, Rana, for a very interesting presentation. I'm going to do what you're not supposed to do in the spirit of this organization, and I'm going to make a couple of observations. I'm not sure it's going to result in a question. The observations revolve around the following. The purpose of this organization, as I understand it, is to think about new approaches to getting things done in Washington. And what I wanted to observe about your presentation is, to some extent, while I agree with a lot of it, almost all of it, the framework sort of revolves around the same practice that we have devolved into in Washington over the past 25 years, and that is, who's to blame? Who's to blame for the financial crisis? Who's to blame for the problems of inequality in the economy right now? And the observation I wanted to make, and I've done, you don't know me, but I've done a lot of work, I've written a lot. I'm an investor, used to be a hedge fund manager. I have a different take on the financial crisis and a different take on the inequality problem in the country. And in particular, what's gone on in the past 10 years since the start of the financial crisis. The financial crisis was not caused by Wall Street, I don't think. Wall Street did what Wall Street does, which is intermediate capital. The mistake that Wall Street made was, when it ran out of buyers for AAA rated mortgage notes, it warehoused the mortgage notes on its own balance sheets, which were highly leveraged. In the wake of the financial crisis, Wall Street was vilified, and there were a whole bunch of regulations that were adopted, many of which, in my view, are inimical to an appropriately functioning economy. If you really want to go back and think about who was responsible for the financial crisis, and I was right in the middle of it, with a big short, okay, long before Paulson was there. It was really the rating agencies that were the enablers of the financial crisis. And to this day, nobody's actually stopped and thought about the way the rating agencies operate. They simply took, without doing due diligence, the models that were created by the investment bankers that were appropriately paid fees to intermediate the structures that ended up taking down the financial system. Now we're shifting our focus to try to attach blame to the next source of prosperity, which is Silicon Valley. And I find that to be a very, very interesting phenomenon. We definitely have an inequality problem in this country that's gotten a lot worse since the financial crisis, because Congress, Washington in general, failed to act. The Obama administration, whether it was its fault or it was the Republicans' fault or whoever you want to blame, there was an absolute vacuum and absence of fiscal policy in the wake of the financial crisis. And so, as you pointed out, the central banks were left holding the bag, and they did everything they could. After they cut interest rates to zero, they began accommodative, extraordinary financial monetary policies. Quantitative easing created a hugely enlarged monetary base, but the money never made it into the economy. because it resided at financial institutions who bought the treasuries. And there was, and this is a key point, an absolute failure of demand for credit. People were retrenching, household balance sheets were deleveraging. I heard you make reference to the fact that mortgage applicants could not receive mortgages. That was because the banks were tightening their underwriting standards. But the result was, what did the financial institutions do? They invested their liquidity in financial markets, which levitated financial markets and benefited the top tier, because the vast majority of
And let me ask you,
people are not in the financial markets.
let me ask you to pose a question to Rana and give her time to
I don't have any questions.
okay.
I only have comments. That's why I joined the call, and I'll step back right now. I mean, there's plenty to talk about, but there's obviously
moderator, and delighted you're here, Rana.
No, I would just make an observation, which is that I actually think that, and I'm sorry, I've forgotten the caller's, the commenter's name, but I think we actually agree on more than you might think. The way that you're describing the situation is right in a lot of ways, but I think you're looking at it in a way that's a little too siloed and case specific. Totally agree with you that Wall Street was doing what Wall Street does. And in fact, that was kind of the quote that Ruth Scheer gave me that I mentioned earlier in the presentation. But why did Wall Street do that? And that's where you have to look back, I would argue, at the last 40 years of regulatory shifts, of shifts in the culture, in our politics, in the way our economy is structured, and say, how did we get there? And unfortunately, and this is kind of a hard part of this narrative, I don't think that there's one silver bullet thing that you can point to. I try and attack a lot of different policy shifts in my book, but I would argue there's been a tremendous number of small shifts in the last 40 years that have created a situation where the financial system is doing exactly what you said it's doing. And we can talk about and should talk about solutions to all the points you've raised, but I think the larger point, which it sounds like we agree on, is that we have a political economy that is not making the right decisions about the kind of financial structures that we need to support the underlying Main Street economy.
I think we agree, Rana, and thank you again. The one point that I would make that I don't think that you did mention was there's something in the new tax law that is actually very constructive, and that is a limitation on interest deductibility for highly leveraged companies. I think that's a constructive move, probably more useful than all of the vocal act and most of Dodd-Frank.
Well, I think that your point about looking at the tax code and figuring out ways to get rid of unproductive, subsidized debt is a very good one. And I would argue that we should go through with a fine-tooth comb and really look for all those points. I think that one of the things I'm a little concerned about is that this was maybe a first go at tax reform by this administration, but it was done in a way that I think didn't treat all parties the same. I'll leave it there. We could have a whole another hour long.
I think we agree again. We should get together when you have time. Thanks, Charlie.
You're welcome. And Rana, just so you know, Dan is in New York and is a member of the council.
Oh, great.
So yeah,
Cool.
easy to do. And I just footnote, they didn't change carried interest, right, in the tax bill, right?
Exactly.
Yeah.
No, they didn't. But again, the interest deductibility limits, which very few people have really talked about, are much more important than that.
Well, it's a very good point, and you maybe the topic of a future column, Dan.
Sure. Thank you.
That's great. Thank you all. Yeah, do we have anybody else who'd like to raise their hand? We have opportunity, a couple more minutes here. If anyone else would like to raise their hand and ask a question of Rana. It's pretty quiet here. Rana, if you had alluded earlier to solutions, and certainly, I think Dan's point about, we don't want to blame any one party. We've got many years of history. Oh, actually, Mark Bregman also has the question. So if we could touch on solutions quickly, and then we do have one more question after that too.
Okay. So let me talk about solutions for a minute, and I'll throw it forward with tech, because that's what I'm thinking of, in part because I pay attention to kind of where the money and power is, and we say tech, we say big tech sometimes, but it's IP rich firms. I think there is an opportunity to even the playing field. If you think about data as the new oil, which I've written about, there's a great economist cover line that uses that term. Ownership of data, who owns the data? How does it get used? How is it regulated? How is it protected? I think we actually have an opportunity, in part because the cost of starting businesses, the need for capital is much less than it was in the past. If there is a way to create more ownership of individual data flows and the ability of people, individual workers, consumers, to monetize that, rather than having a system which I think we do have now, where you've got a monopoly control by a few large firms. And it's not even just a few large firms versus individuals in terms of wealth share. It's a few large firms versus pretty much all the other firms. And I think that that's going to be a big and interesting corporate battle playing out. But, I wrote a little bit about this in my book. I've written about it in other columns, ways in which platform technologies can be used to equalize things. You look at cooperative corporate structures, ways in which workers can create, like New York City taxi drivers have their own version of Uber now. This doesn't solve all the problems, but it's one way of thinking about structurally, if data is the new oil, how do you make sure that wealth is shared?
That's great, thank you. I'm going to turn now to Mark Bregman, actually one of our board members. He has a question. Mark, you have the spotlight.
Thanks. This gets back a little bit also to the tech question. You mentioned earlier, you talked about companies like Apple and others that have benefited from large investments made by the central federal government. And while that's true, and that's been the foundation of an enormous amount of wealth creation, additional formation of companies and so on, one of my fears is that currently we see a dramatic reduction in the basic or foundational research funded by the government and also funded by private industry. The private industry side is reductions in those fundings, I think, is largely due to the intense financial returns focus. I was at IBM in the early 80s, and we had a fraction of 1% of our total revenue was spent on very fundamental basic science. That is no longer true because the owners, the shareholders, view that as their money. Why should we spend it on that? Unfortunately, the same thing has happened at the federal funding level, where increasingly various constituencies want to know, before money is spent, tell me the outcome, the benefit, the specific result this investment will have. And in the world of basic science research, that's not knowable. So I worry that we're eating our seed corn, or we are no longer putting aside seed corn for the future. And while these very large corporations are generating huge wealth, they're building it on the back of research that was funded 20, 30, 40 years ago and hasn't been funded for the last 15 or 20 years.
Totally agree with you. And in fact, I have a chart in my book that looks at this juxtaposition from the 80s onward. And you can see there's a line looking at the number, the amount of corporate revenue spent on share buybacks going up, amount of R&D as a percentage of revenue going down. And so those things really make a perfect X. And I think it is for the very reasons that you mentioned. And I have actually some colorful examples of CEOs saying just that. And you can look at the numbers. I mean, when a company announces that they're going to do a big R&D spend, their share price will almost always go down. Yeah. Whereas when they announce that they're going to hand back cash, it always goes up. I think that this is a huge issue front and center now, in part because we have, competitors in China, state-funded players that are just not playing by the same rules and don't have the same timelines. I think that's a huge issue for companies. I think that there's a lot that could be done both with the tax code in terms of really incentivizing R&D. I mean, it's amazing to me that we have not created more real quid pro quo to help firms to make those investments. I think talking about human capital as well is a kind of another part of this, not just R&D into basic science, but R&D into people, because, IP wealth is really about brains and talent. We allow certain kind of amortization and accounting for pieces of equipment, but not for the talent that lives within a firm. And I think that that's an interesting conversation that could be had as part of this Larry Fink, long-term versus short-termism. What should the new metrics be issue?
Rana, I know Sarah keeps us to 1 hour, so if I could just sneak in before 4 o'clock, not a question, but a comment. If you could just tell your folks at the Financial Times, I would just change one thing, and that is to have you have a column every day.
Awesome. All right. I hope Lionel.
That may be difficult for you, but no, seriously, I find what you write extremely enlightening and really, it's a trite word, cutting edge, but I mean, you spark a lot of thinking, and I'm glad to see that people on Wall Street and the tech community still talk with you, and that they're
They really do. I mean, more on Wall Street, I'll say, but some of the tech community talks to me. I hope more will.